Okay, so we know what internal control is and what companies should be doing, but sometimes there's a breakdown in internal control and fraud still happens. And so there was some big companies where there was fraudulent activity in the early 2000s. Enron was an energy company based down in Houston, and they were one of the largest companies in the world, and there was fraud committed by the top executives of the company, caused the company to go bankrupt. WorldCom was a big telecommunications company, and again, there was fraud by the CEO and caused the company again to go bankrupt. And so when that happened, people got scared. They saw some people lost their life savings. People had their 401ks invested in their company stock, and they just lost everything. And so that made people saying, well, I'm not going to buy stock in companies because I could lose all of it. And our economy does not work if people are afraid to invest in stock. So we had a congressman and a senator, Sarbanes-Oxley, that enacted this legislation requiring, so a law requiring things from publicly traded companies to be more transparent about their financial reporting. And so some of the things that the Sarbanes-Oxley Act did, they established a public company oversight board. So this board is overseen by the Securities and Exchange Commission, the SEC, and they are in charge of the public accounting firms that do the audits for the publicly traded companies. So you have to register. If you want to audit a publicly traded company, the firm needs to register with this public company oversight board. And they have to follow their protocols. So if for an auditor, they have to maintain their audit work papers for 7 years, because that was a big thing in Enron. The firm, Arthur Andersen, actually, they were a real strong company. They were headquartered in Chicago, and the folks here in Chicago didn't have anything to do with what went down with Enron in Texas. It was the Houston office of Arthur Andersen, but Arthur Andersen ended up going bankrupt as well, dissolving as well. And so one of the things Arthur Andersen did, once they found out that the scandal at Enron was being revealed, they just started shredding all of their audit work papers. And they were then charged with obstruction of justice, and that's why they ended up being dissolved. A second partner must review the audit report. It's really important that the accounting firm is independent, right? They shouldn't have anything to do with the company that they're auditing. Well, it's kind of hard in the accounting firm. The partners are more like salesmen than they are accountants. They have to go out and they have to get business. They have to get clients for their firm. So they have to get to know, their executives really well so that they'll hire them as an auditor. And so are they necessarily being completely independent? So that's why they want a second partner who doesn't, take them out to dinner or to the ball game or whatever to try and get their business. They want a second partner to come in and review the audit report. They have to document their internal control testing. So as part of the audit, the auditors have to test the internal controls. They have to make sure they document how they did that. They can provide bookkeeping or consulting services to audit clients. So this was a big hit to the public accounting firms, because in order to keep their independence, they have to choose, am I going to be the auditor or am I going to be the consultant? Because consulting is actually, a lot of revenue involved with consulting. The audit partners have to rotate every 5 years. And if an audit employee, so if somebody from the public accounting firm gets hired by the company as a CEO, controller, CFO, chief accounting officer, then the firm can't perform the audit for 1 year. They have to switch to another accounting firm, and then they'll probably stay with that other accounting firm for a few years at least. Okay. Most of the Sarbanes-Oxley Act has to do with the corporation. Okay. And I've read the Sarbanes-Oxley Act. It basically is just trying to plug up all of the loopholes that Enron and WorldCom exposed when they committed their fraud. So the CEO and the CFO have to sign off that they've reviewed the audit report the financial statements don't contain material misstatements. So this was a big thing, because what happened, particularly with Enron, and actually I have a link on our resources to a movie called The Smartest Guys in the Room. It's about the Enron scandal. It's pretty good. You can get it on YouTube at least. But anyway, what happened there was the CEO, Jeffrey Skilling, said, well, I didn't know what they did. The accountants did whatever. I didn't have anything to do with that. And I don't know that was true to begin with, but they can't get away with that. Say, oh, that's all done in accounting. They're told now they have to take responsibility. They have to sign off. So they have to know what's in those financial statements. They have to store records for at least 5 years. So even emails have to be stored. And so that costs money to be able to store everything. So this companies weren't happy with this. Enhanced financial disclosures. One of the things they did at Enron was they set up all of these special purpose entities that are allowed under GAAP. They're intended to be used mostly for, say, like a construction project, where you can report information for a special purpose entity on its own balance sheet. But what ended up happening was they just kind of set up all these special purpose entities, and they would sell assets to the special purpose entities. So they were basically selling things to themselves, and they were then reporting the revenue on the Enron financial statements. And then when they needed to borrow money, they borrowed money through the special purpose entities. So they didn't have to show the liabilities on their financial statements. So you think about like the debt ratio that we calculated. Their debt ratio looked great because they were not carrying the debt, they were hiding it. Okay. Prohibits loans to officers. That was from WorldCom. WorldCom, they lent the CEO like $400 million. And then when they went bankrupt, that money, they didn't have that money, that should have gone to be paying the stockholders, creditors and the stockholders. Stockholders with more than 10% ownership have to file a statement if they have a change in ownership. So when the executives at Enron realized that the fraud was going to be exposed, they went and they sold all their stock so that they could get their money out. And the stock price ended up plummeting. And so, people that had their stock in their 401k plans, right, just regular working class people, by the time they realized something was going on, the stock was worthless, so they didn't get their money out. So now if you see your CEOs making, trading a lot of stock, then you know that something's going to be going on. And then a code of ethics. Ethics became a big focal point. That's why to get a degree in business, you are going to have to take a business ethics class. Some other things that Sarbanes-Oxley requires. An audit committee. And so the problem is, when the fraud is being perpetuated by the top people of the company, who do you tell about it? Your boss tells you to make a fraudulent journal entry. I mean, what can you do other than quit your job? And that's very hard for people. You can't quit a job until you have another job. So we have an audit committee where you can tell, this is independent individuals on the audit committee, and you have someone to report activity to. A lot of companies have established hotlines, anonymous hotlines, just for that reason. There's a whistleblower provision, so it's supposed to protect people who report fraudulent activity. And then fines and prison time. So this is supposed to be the deterrent for executives. If you inaccurately certify that your financial statements don't contain material misstatements, $1 million fine, you could get 10 years in prison. If you certify it fraudulently, $5 million fine, 20 years in prison. If auditors don't keep their work papers for 5 years, they could face 10 years in prison. So that's a pretty big incentive. Okay, so that's the Sarbanes-Oxley Act that publicly traded companies need to follow. The last thing I want to do is I want to look at an internal control case and talk about the weaknesses. Actually, I'm going to make a separate video to talk about this case.